Imagine waking up and it's April 27, 2026.
Right.
You sit down, you open your laptop, and you look at two completely different dashboards of the global economy.
Yeah, the split screen effect.
Exactly. On one screen, you have the stock market, and the S&P 500 and the NASDAQ are they are rocketing to these historical, unprecedented highs.
Breaking records almost daily.
Right. The numbers are frankly dizzying. It looks like this absolute golden age of financial euphoria, but then...
And you look at the physical world.
Yes, you turn your head to the other screen, the
Right.
physical world, and you see cargo planes literally emergency airlifting basic groceries into the Middle East.
Because the oceans are just too dangerous to cross right now.
Exactly. You see this literal physical war that is choking off a fifth of the global energy supply. And, you see everyday consumers absolutely terrified of the bills arriving in their mailboxes.
It's the ultimate cognitive dissonance.
It really is.
I mean, the sources you've brought together for this deep dive today, they paint a picture of two parallel realities, and they're somehow occupying the exact same space and time.
Which feels impossible.
Right. We are looking at a market that is pricing in a technological utopia while completely ignoring the geopolitical and economic anxiety that is currently tearing the physical supply chain apart.
So that is exactly what we need to unpack today. Welcome to the Deep Dive, everyone. Our mission today is to figure out the sheer scale of this disconnect.
Because it can't last forever.
No, it can't. You cannot have the digital economy partying like it's the roaring 20s while the physical economy is bracing for a 1970s-style collapse.
Not without something eventually breaking.
Exactly. So here's our roadmap for today. First, we'll examine this wild divergence in the stock indices. Then we'll dive into the stark realities of the Iran war's economic fallout.
The physical shock.
Right. After that, we're going to look at the AI tech boom that's basically keeping the economy afloat. Then we have to navigate the intense political drama happening over at the Federal Reserve.
Oh yeah, that's a huge piece of the puzzle.
It's a mess. And finally, we'll bring it all home to how this actually impacts you, the everyday consumer, and the global markets. So, okay, let's unpack this. Let's look at the actual numbers from Monday, April 27.
Because they perfectly illustrate this split personality we're talking about.
They really do. So the S&P 500 closed at a record high of 7,173.91. That is up roughly 0.12% for the day.
Yeah.
And the NASDAQ composite hit its own record, 24,887.70, up 0.2%.
And we really need to contextualize that 7,173 number for the S&P.
Please do, because it feels high.
It's staggeringly high. The index only crossed the 7,000 threshold 12 days prior, on April 15.
Wow. 12 days?
Right. The velocity of this move is just staggering. If we look back at the trough of the market cycle in October 2022, the index has effectively doubled.
Wait, really? 100% gain?
100% gain.
Oh,
You're
yeah.
talking about a fundamental, massive, broad market index doubling over a relatively compressed time frame.
But here is where the diagnostic dashboard starts flashing those contradictory signals, right?
The divergence.
Because while the S&P and the NASDAQ are popping champagne, the Dow Jones Industrial Average actually dropped. It fell nearly 63 points on that exact same day.
Right.
And the Russell 2000, which tracks all those smaller capitalization companies, it was virtually flat.
Which tells us a lot.
It tells us we aren't seeing a rising tide lifting all boats. We are seeing a very specific aggressive rotation.
Rotation is the key word there. That is exactly what we're witnessing. It's a massive, calculated repositioning of capital by institutional investors.
So where is the money going?
Well, money is actively fleeing cyclical blue-chip industrials. The market is aggressively discounting companies that manufacture physical goods or rely on heavy logistics or are highly sensitive to raw material inflation.
Because those are the ones getting hammered by the physical world's problem.
Exactly. Capital is abandoning those vulnerable sectors and effectively seeking asylum in high-growth technology.
So it's a massive capital flight from the physical world to the digital world.
Totally.
The institutional money is looking at the horizon. They see a massive Federal Reserve decision looming. They see the peak of the first quarter corporate earnings season.
And they want absolutely nothing to do with companies exposed to energy costs.
Right. They are parking billions in semiconductor and AI infrastructure companies because, at least on paper, a massive data center running AI models doesn't care if a cargo ship can't cross the Red Sea.
That's the logic. It's a highly sophisticated wait-and-see approach. Institutional managers are essentially saying, look, I cannot quantify the downside risk of the industrial sector right now.
Because the geopolitical situation is just too fluid.
Right. So they buy into the AI narrative as a safe haven. It fundamentally breaks the traditional definition of a defensive stock.
Because historically, what do you buy when a war breaks out? Defense contractors, utilities, maybe gold.
Exactly. But today,
Yeah.
they buy tech infrastructure.
I was looking at the weighting of these indices in the source material, and it struck me that the broader economy right now, it's functioning like a massive car with a completely blown transmission.
I like that analogy.
Right. Like the underlying mechanics, the industrials, the supply chains, the transportation networks, they are just grinding and struggling.
Full of stress fractures.
Yeah. But someone has strapped a massive state-of-the-art rocket engine to the roof of this car.
The tech sector, AI.
Exactly. And that rocket is generating so much raw, unprecedented thrust that it's just pulling the whole broken vehicle forward anyway.
The sheer market capitalization of the tech sector is dragging the entire S&P 500 upward.
Completely masking the structural failures happening in the physical economy underneath it.
And the arithmetic of capitalization-weighted indices practically guarantees this illusion. When your engines are worth trillions of dollars, their daily movements simply mathematically overpower the localized damage in the industrial sectors.
Right, the math hides the pain.
It does. But the fundamental stress fractures in that transmission, as you put it, are severe. The industrial and defensive sectors are struggling because they're absorbing the full, unfiltered impact of a massive exogenous shock.
So let's pivot to the physical reality of that shock. Because why are those sectors struggling so much? It comes down to the 2026 Iran war.
Which is dictating the terms of global trade right now.
Entirely. The sources note the military strikes were initiated on February 28, but the real economic devastation, that locked in on March 4.
When the Strait of Hormuz was effectively closed to maritime traffic.
Right. And for anyone mapping the global energy grid, the Strait of Hormuz is, it's the main artery.
It's the bottleneck of the world. Closing it severs roughly 20% of the world's daily oil supply.
20%? That is massive.
And that's alongside massive volumes of liquefied natural gas. And you have to understand, the market mechanics of energy are incredibly inelastic in the short term.
Meaning you can't just find that 20% somewhere else.
Exactly. You cannot simply conjure 20% of global oil demand from alternative sources overnight. When a fifth of the world's lifeblood is suddenly trapped in the Persian Gulf, the price action is violent.
Which we saw, right? We saw Brent crude surge past $120 a barrel in the early weeks of the conflict.
Yes. And even now, late April, despite the diplomatic noise and, a previously announced ceasefire, the physical reality on the water is that tankers are still not moving.
Because it's just too dangerous. The risk premiums for maritime insurance are astronomically high.
Making the strait effectively unnavigable for commercial vessels.
Right. That's why we saw oil prices climb another 2% on Monday, with WTI crude topping $97 and Brent crude trading firmly around $108.
The market has internalized a massive, perhaps permanent, geopolitical premium. And what makes this specific conflict so economically destructive is the actual nature of the warfare itself.
The sources repeatedly use this term, and it's wild. They call it Houthifcation.
Houthifcation, yes, to describe the tactical evolution of this war.
I found that concept fascinating, though honestly, deeply grim. We aren't talking about massive mechanized armies clashing over borders in a conventional sense.
No, not at all.
Houthifcation implies a prolonged, asymmetric war of attrition. It's heavily reliant on drones, localized missiles, targeted maritime blockades.
It's a strategy designed specifically to paralyze economic movement rather than conquer territory.
Exactly. It weaponizes the fragility of the just-in-time global logistics network.
Right, because when a non-state actor or a localized military force can deploy relatively cheap drone technology to threaten multi-million-dollar cargo vessels, the economic calculus of global shipping just collapses.
The math doesn't work anymore.
It doesn't. A regional war in the 21st century isn't just about bombs. It is a deliberate heart attack induced upon the global supply chain.
And the immediate ground-level consequences are staggering. The sources document what they call a literal grocery supply emergency across the Gulf Cooperation Council, the GCC states.
Yeah, that date is terrifying.
By mid-March, a full 70% of food imports to that region were disrupted. We saw retailers resorting to emergency airlifts for basic staples.
And you don't put flour and cooking oil on a 747 cargo plane unless the situation is absolutely dire.
No. The economics of air freight versus maritime shipping are brutal. You were talking about moving from the cheapest form of bulk transport to the most expensive,
And when a region has to airlift 70% of its caloric intake, those exorbitant logistics costs are instantly passed on to the end consumer.
which the sources cite, right. They mention price spikes of up to 120% for basic goods in these markets.
120%. It is an immediate catastrophic erosion of purchasing power.
But, the ripple effects within the corporate energy sector are equally fascinating, especially when you look at how different legacy giants are weathering the storm.
There's a huge divide there.
Yeah. If you just glance at 108 daters Brent crude, you'd assume every major oil conglomerate is just printing money. But the sources highlight a massive divergence between BP and ExxonMobil.
It's a tale of two business models, really.
BP is crushing it. They're emerging as the top-performing stock in the sector, with what the sources call exceptional trading profits. But Exxon, conversely, is actually struggling.
And it perfectly illustrates how operational agility is superseding sheer scale in the modern geopolitical landscape.
How so?
Well, look at ExxonMobil. They have a massive physical footprint. They have roughly 5 times the physical production exposure in the Persian Gulf region compared to a rival like Chevron.
Oh, wow. 5 times.
Right. So while the price of the commodity they extract is sky high, they physically cannot get their product out of the ground and through the blockade to monetize it.
So they just have stranded assets in a war zone.
Exactly. While BP is playing a completely different game, their physical footprint in the conflict zone is smaller, but their trading desks are incredibly agile.
So they aren't relying purely on physical extraction.
No, they are capitalizing on the massive price volatility in the paper markets and through rerouting global shipments. They are basically trading the chaos, whereas Exxon is bogged down by the physical reality of the blockade.
That's wild. It's a critical lesson for institutional investors, I guess. In an era of asymmetric warfare and supply chain weaponization, a company's ability to pivot its operations and hedge its exposure is far more valuable than simply possessing the largest physical reserve.
BP is monetizing the volatility. Exxon is victimized by it.
Okay, but looking at all this data, I want to push back a bit. I'm struck by a massive contradiction that the market seems to be willfully ignoring.
Sure.
If 20% of the world's oil is structurally blocked from the market, and we are seeing emergency food airlifts and gas in the U.S. is well over $4 a gallon, how on earth is the S&P 500 hitting 7,173?
It's a big question.
Right. The macro environment you just described sounds exactly like the 1970s oil embargo, and that triggered a massive grinding bear market and years of economic malaise. Why isn't the entire global economy tanking right now?
If we connect this to the bigger picture, that is the central mystery of April 2026. The market is entirely aware of the physical bottleneck, but it is making a colossal multi-trillion-dollar wager on a countervailing force.
The AI shield.
Exactly. Investors are betting that the deployment of artificial intelligence will generate a wave of industrial productivity so massive and so deflationary that it will entirely overwhelm the inflationary drag of the energy crisis.
So they believe that the economic gravity of 108 oil can be entirely negated by the efficiency gains of silicon.
They believe we are at the inflection point of a new industrial revolution. In the 1970s, there was no technological breakthrough massive enough to offset the oil shock.
But today, capital is convinced that AI is that breakthrough.
Right. They believe AI will optimize energy grids, streamline logistics, automate massive swaths of white-collar labor, and drive corporate margins so high that the cost of energy just becomes a secondary concern.
And the armor plating of that shield is the semiconductor industry.
Oh, absolutely.
Because the metrics coming out of the chip sector are practically defying the laws of financial physics. The PHLX semiconductor index, the SOX, just capped an 18-session winning streak.
Which is unheard of.
It gained 10% in a single week. And it's up an astonishing 48% year-to-date. I mean, NVIDIA is the obvious titan here, crossing a market capitalization of $5 trillion.
The $5 trillion elephant in the room.
Yeah. But the real structural shift in the AI narrative on April 27 actually came from Intel.
The Intel earnings report was a massive psychological pivot for the market.
Really? More than NVIDIA?
In terms of the narrative, yes. Intel surged 23.6% in a single trading session. To put that in historical context, that is Intel's best single-day performance since 1987.
1987, that is almost 40 years.
Right. They reported 29 cents per share on $13.58 billion in revenue, beating estimates handily. But the stock price surge wasn't just about the raw numbers.
It was about what those numbers represented for the life cycle of artificial
Oh,
intelligence.
yeah, okay.
Because, okay, for the last 3 years, the entire AI gold rush was focused almost exclusively on GPUs, right? Graphics processing units.
The absolute behemoths that NVIDIA designs.
Right. You need massive, incredibly expensive, highly specialized GPU clusters to train foundational AI models. I like to think of it like sending a medical student to a decade of specialized schooling.
That's a great way to look at it.
It takes immense resources, time, and computing power to ingest all that data and form the neural pathways.
The training phase is intensely resource-heavy, and NVIDIA essentially held a monopoly on the architecture required to do it efficiently.
But Intel's massive rally signals that the market is looking at the next phase, inference.
Yes, inference is the key word here.
Right, because once that AI model is trained, once the medical student graduates and becomes a doctor, it doesn't need to relearn the entire corpus of human medicine every time it diagnoses a patient.
It just takes the new data, the patient's symptoms, and applies its existing knowledge.
Exactly, that is inference. And the market is suddenly realizing that you don't necessarily need a $30,000 NVIDIA GPU to do inference at scale.
No, you don't.
Yeah.
You can run those localized tasks incredibly efficiently on the legacy architecture of CPUs, central processing units.
Which Intel has been manufacturing at global scale for decades.
It is a critical maturation of the AI economy. The market is shifting its focus from the infrastructure build-out to the actual software deployment.
And the realization that inference can be handled by highly optimized, widely available CPUs changes the margin profile for every tech company trying to deploy AI features to end users.
It completely democratizes the processing power.
And we saw this play out with Qualcomm as well, didn't we?
We did.
They jumped 9% on the news of a strategic partnership with OpenAI, specifically focused on embedding AI chips directly into edge devices like smartphones.
And the sources noted this move actively threatened Apple, pushing their stock down 1.5%.
So the hardware war is moving from the massive centralized data center straight to the device in your pocket.
Which is incredibly bullish for the semiconductor sector as a whole. But, and this is a big but, it also triggers some severe technical warning signs.
Right. The sources point out that the relative strength index, the RSI for these chip stocks, has pushed above 85.
Which is a huge red flag.
For those listening who might not track market momentum every day, can you explain the RSI simply? Because an RSI over 85 is historically incredibly dangerous territory.
It really is. The RSI essentially measures the velocity and magnitude of recent price changes to evaluate overvalued or undervalued conditions. Usually anything over 70 indicates a security is overbought.
So hitting 85.
Hitting 85 means the momentum has completely detached from underlying fundamentals and is being driven almost entirely by speculative fever. It is the financial equivalent of redlining a car engine.
So when an entire sector hits an RSI of 85, the probability of a violent mean reversion, like a sudden, sharp correction, increases exponentially.
Exponentially. The market is highly vulnerable to any piece of news that disrupts the narrative of uninterrupted exponential AI growth.
And that vulnerability isn't just theoretical. It loops right back to the physical world and the Iran war we were just talking about.
Everything is connected.
The sources explicitly flag that the ongoing conflict is beginning to pressure circuit board supply chains. The tech sector loves to view itself as existing purely in the cloud, but the cloud is built on servers. Servers are built on circuit boards, and circuit boards require raw materials and complex physical logistics.
Atoms. Hardware requires atoms.
Exactly. If the supply chains for basic silicon components are delayed by maritime blockades, the entire timeline for AI deployment gets pushed back.
The digital economy cannot entirely divorce itself from the physical economy, and those atoms have to be shipped. That is the Achilles heel of the AI shield.
And there is a second massive vulnerability here, the cost of capital required to fund this multi-trillion-dollar build-out.
Right, because building hyperscale data centers and retooling semiconductor fabrication plants requires mountains of debt.
And the cost of that debt is determined by the Federal Reserve. Which brings us to the political theater currently unfolding around the Federal Open Market Committee meeting.
This is where it gets really complicated.
Oh, yeah. They are widely expected to hold the benchmark interest rate at 3.75%. But the interest rate itself is almost a footnote compared to the leadership crisis.
Because this April meeting is expected to be Chair Jerome Powell's swan song.
Right. And the succession process is completely paralyzed by political warfare. Now, looking at the sources, we must navigate this with absolute neutrality as the claims being thrown around Washington right now are highly charged and heavily partisan.
Yes. Our role here is to dissect how this political deadlock is impacting the financial markets, not to validate the political accusations themselves.
Exactly. So, just reporting what the sources say. The White House has nominated Kevin Warsh, a former Fed governor with a strong academic background, to succeed Powell.
But Warsh's confirmation is completely stalled in the Senate.
According to the sources, Republican Senator Tom Tillis is holding up the vote.
Right. He is refusing to allow the confirmation process to move forward until the Department of Justice officially drops a criminal probe into outgoing Chair Jerome Powell.
And the probe is ostensibly focused on cost overruns associated with the renovation of the Federal Reserve's headquarters.
However, the sources note that some have characterized this DOJ investigation as a targeted political pressure campaign designed to coerce the Fed into lowering interest rates ahead of an election cycle.
So that's the claim on one side. Simultaneously, Warsh is facing intense opposition from the other side of the aisle.
Right. Democratic Senator Elizabeth Warren has fiercely criticized the nomination,
Reportedly referring to Warsh as a sock puppet for the White House.
She is publicly challenging his ability to maintain central bank independence. And she cites the fact that the president has a history of publicly attacking Fed leadership, previously calling them fool and too stupid when they didn't align with his policy preferences.
Now, the sources do note that Warsh explicitly testified during his confirmation hearings that he has made absolutely zero commitments to the president regarding future interest rate decisions.
He was very clear about that on the record.
But honestly, regardless of the truth of any of these claims, the sheer volume of political friction surrounding the central bank is terrifying to institutional investors.
Because the core premise of modern fiat currency and global financial stability is the absolute independence of the central bank.
Right. The Federal Reserve must be able to make deeply unpopular decisions, like raising interest rates and causing recessions to kill inflation, without fear of political retribution.
Exactly. If the global bond market begins to suspect that U.S. monetary policy is being dictated by electoral strategies or DOJ leverage rather than economic data,
The credibility of the U.S. dollar itself is compromised.
it is a very dangerous game.
And what makes this leadership vacuum so fascinating is the economic philosophy that Kevin Warsh is bringing to the table. Warsh historically built his reputation as a monetary hawk, right?
Yes, someone structurally biased toward tighter money and higher interest rates to preemptively crush inflation.
But the sources outline that during his confirmation, he presented a radical supply-side thesis deeply intertwined with the AI boom.
This raises an important question because the Warsh thesis is currently the most heavily debated concept on Wall Street.
So what is his argument?
He is arguing that the massive productivity gains generated by artificial intelligence will act as a structural deflationary force on the broader economy.
Meaning things will get cheaper because of AI.
Right. If companies can produce more output with significantly lower labor and operational costs, prices should naturally fall. Warsh's argument is that this AI-driven deflation might provide the Federal Reserve with the macroeconomic cover to actually lower interest rates, despite the immense inflationary pressures emanating from the Iran war and the energy markets.
Okay, I have to jump in here. I am highly skeptical of this framework, and I think it warrants some serious pushback.
Go for it.
Warsh's theory relies on an assumption of timing that seems incredibly fragile. He is suggesting we can lower interest rates today because AI will supposedly fix the supply side of the economy tomorrow.
Right.
But is that a realistic economic model? Or is it just a convenient pseudo-intellectual justification designed by Wall Street to keep the era of cheap capital alive?
It's a very fair critique.
Because it feels like an excuse to prevent the stock market from crashing while actively ignoring the fact that crude oil is sitting at $108 a barrel.
The timeline mismatch is the exact flaw critics of the Warsh thesis point out. You are absolutely right to question the synchronization. The inflationary shock of the Iran war is happening right now, in real time.
It is bleeding the consumer today.
Exactly. The productivity miracle of AI inference, however, requires years of corporate integration, software deployment, and workflow restructuring to actually show up in the macroeconomic data.
You can't just flip a switch and suddenly everything is efficient.
No. If the Fed cuts rates based on the promise of AI efficiency in 2030, they risk allowing the energy-driven inflation of 2026 to become entrenched and spiral completely out of control.
And the people bearing the brunt of that timeline mismatch aren't the institutional investors. It's the everyday consumer.
The disconnect is brutal.
The disconnect between the AI utopian narrative and the physical reality of the economy is violently apparent when you look at consumer data from this April. The consumer paradox is just staggering.
It really is.
If you just look at the top-line data, the sources show U.S. retail sales actually rose 1.7% in March, which is the strongest monthly gain since early 2023. And the unemployment rate is still remarkably low at 4.3%.
On paper, the consumer looks incredibly resilient.
On paper. But the composition of that retail spending reveals a deeply distressed consumer base.
You cannot look at the aggregate 1.7% increase without dissecting where that money went.
Right, because the sources explicitly highlight that this increase was heavily distorted by a massive 16% jump in gas station receipts.
Yes, when the national average for a gallon of gas hits $4.04, which the sources note happened on March 31st, people are forced to spend significantly more money just to commute to their job.
Exactly. That necessary expenditure gets logged as an increase in retail sales, but it is the exact opposite of economic vitality.
It is a regressive tax on the working class.
It is a direct, unavoidable drain on disposable income. If you strip out the volatile components of gasoline and automobiles, core retail sales only managed a meager 0.65% increase.
Which explains why the psychological metrics are completely decoupled from the top-line spending data.
Yeah, let's talk about the sentiment data.
The University of Michigan Consumer Sentiment Index, which is a crucial barometer of how Americans actually feel about their financial future, plummeted to 49.8.
49.8.
To provide historical context, the sources note that a reading of 49.8 is roughly 40% below the historical average of the index dating back to 1978.
Wow.
It is a level of pessimism usually reserved for the depths of a severe recession.
The consumer is spending more, but they feel like they are drowning, and their expectations for the future are grim.
The sources show that one-year inflation expectations has surged back up to 4.7%.
So consumers are experiencing the early suffocating stages of stagflation.
Stagflation is the ultimate macroeconomic nightmare. It's the toxic combination of stagnant economic growth and stubbornly high inflation.
And the traditional tools used by central banks become entirely paralyzed in a stagflationary environment, right?
Completely. Because if you lower rates to stimulate growth, you pour gasoline on the inflation fire. If you raise rates to kill inflation, you crush the remaining life out of the consumer and trigger a deep recession.
And the consumer is currently trapped in the vice grip of these dual pressures. Here's where it gets really interesting, because on one side, they are being bludgeoned by the exogenous shock,
The $4.04 gas.
the 120% food inflation spikes in global supply chains bleeding into domestic prices. But on the other side, the Federal Reserve's sustained fight against that inflation has kept the cost of borrowing painfully high.
The sources note the 30-year fixed mortgage rate is hovering at 6.329%, with the 10-year Treasury yield sitting at 4.336%.
Those mortgage rates have effectively frozen the U.S. housing market.
It is structural gridlock.
Yeah. Potential buyers are priced out by the combination of high asset prices and high borrowing costs. Simultaneously, current homeowners who locked in sub-3% mortgages during the pandemic era, they just refuse to sell.
Because moving would mean voluntarily taking on a 6.3% mortgage.
Exactly. The velocity of transactions in the real estate sector has simply collapsed. This brings us back to the cognitive dissonance we opened with.
The split screen.
The consumer paradox is the ultimate manifestation of the broken diagnostic dashboard. I relate this directly to the listener's life. It's the difference between looking at your 401k balance and looking at your grocery receipts.
Yeah, that's it perfectly.
You log into your brokerage account, and your 401k balance looks fantastic because it is heavily weighted toward S&P 500 tech giants that are riding the AI wave.
But then you close your laptop, you walk to the grocery store, you fill up your gas tank, and your actual lived experience is characterized by shrinking purchasing power and intense financial anxiety.
The digital economy is a bull market. The physical economy is a bear market.
But these two economies are not permanently isolated. They are deeply, structurally intertwined. Eventually, the digital economy has to sell its software, its hardware, and its AI inference capabilities to the physical economy.
And if the physical consumer is exhausted, the tech sector's revenue models eventually break down.
Exactly. And that collision point, the moment where the AI narrative has to prove its value to a distressed physical economy, is happening right now.
We are entering what I can only describe as earnings roulette.
Oh man, yes we are.
This specific week in late April 2026 is the absolute peak of the Q1 earnings season. And we aren't just waiting on random companies. We are waiting on five of the Magnificent Seven.
The heavy hitters.
Amazon, Alphabet, Meta, Apple, and Microsoft are all opening their books this week.
The mathematical concentration of risk here cannot be overstated. Those five companies alone represent approximately 44% of the entire market capitalization of the S&P 500.
Almost half the market.
The index's ability to hold that historic 7,173 level is almost entirely dependent on the forward guidance of these specific management teams.
And the bar for success is exceptionally high. The sources show that out of the 139 companies in the S&P 500 that have already reported this quarter, 81% of them beat Wall Street estimates, and aggregate earnings growth is tracking at a very robust 16.1%.
So the broader market is delivering.
Which means the Mag 7 can't just be good. They have to be spectacular to justify their valuations.
What's fascinating here is if a company like Microsoft or Alphabet shows any sign of weakness in their ability to actually monetize their massive AI investments.
If their CapEx is skyrocketing, but the software revenue isn't materializing because enterprise clients are tightening their budgets.
That RSI of 85 will trigger a cascade of selling.
And we actually got a preview of how violently the market will punish weakness when we looked at the early reporters on Monday. The divergence in the broader consumer economy was on full display.
Yeah, let's look at Verizon versus Domino's.
Right. Verizon reported and managed to raise their forward guidance based on adding 55,000 net postpaid phone subscribers. And the market rewarded them with a 2.6% bump in their stock price.
Telecommunications is often viewed as an essential utility. Even a distressed consumer will prioritize their cellular connection. But then you look at the discretionary side of the consumer ledger, and the picture is entirely different.
Domino's Pizza. The sources note that Domino's missed Wall Street's expectations for first quarter sales and issued a highly disappointing forward forecast.
And the stock tanked.
Their stock didn't just dip, it cratered, dropping 8.8% in a single trading session. I look at that 8.8% drop, and I don't just see a company struggling to sell pizza. I see the exact elasticity of demand we've been talking about.
It's the stagflationary squeeze in action.
Domino's is the canary in the coal mine. Because when your commute costs $4.04 a gallon and your mortgage payment is stretching your budget to the breaking point, ordering a delivery pizza is the absolute first discretionary luxury you eliminate.
The exhausted consumer is aggressively cutting the fat.
Exactly. And this economic fragmentation isn't just happening across consumer sectors. It is actively reordering global equity markets. The way different countries are reacting to the Iran war and the AI boom reveals deep structural truths about their underlying economies.
The divergence between Asia and Europe right now is historic.
The sources outline a massive, undeniable divergence. Let's look at Japan. The Nikkei 225 index surged 1.4% on Monday alone, closing at a massive new high of 60,537.
And if you zoom out to the year-to-date performance, the Nikkei is up an incredible 20.3%.
It is the highest performing major world market by a wide margin. We also saw South Korea's KOSPI index jump 2%.
Now compare that to the European theater. Over the exact same time frame, the major European indices have been battered.
Right. The FTSE 100 in the UK, the DAX in Germany, the CAC 40 in France, all of them fell more than 2% over the preceding week.
And the sources specifically note that German business confidence has deteriorated to its lowest level since the depths of the 2020 pandemic lockdowns.
So why is Japan soaring while Germany, the traditional economic engine of Europe, is sinking? I mean, they are both major manufacturing hubs.
It comes down to how their industrial bases align with the current macroeconomic shock. Japan and South Korea have spent decades structuring their economies around advanced technology, semiconductor fabrication, and high-end robotics.
So they are perfectly positioned to be the primary hardware suppliers for the AI industrial revolution.
Exactly. Furthermore, while Japan imports nearly all its energy, it has built an incredibly energy-efficient industrial infrastructure out of necessity over the last few decades.
Whereas Germany's traditional economic model relied heavily on cheap, abundant energy, historically from Russia and subsequently from the Middle East, to power heavy traditional manufacturing like chemicals and automobiles.
Precisely. Europe is geographically proximate to the Middle East conflict, and their industrial composition is hyper-vulnerable to the supply shock in the Strait of Hormuz.
When Brent crude hits $108, the margins of German heavy industry evaporate.
Japan is surfing the AI hardware wave. Germany is drowning in the geopolitical energy crisis.
But what is truly wild is that amidst all this immense macroeconomic chaos, a regional war, the threat of stagflation, a frozen housing market, and massive political theater at the Fed, the corporate titans are not pausing to see how things play out.
No, they are making massive moves.
The sources show major mergers and acquisitions and massive leadership shifts being announced right into the teeth of this volatility.
Institutional capital abhors a vacuum, and sophisticated management teams use periods of distress to execute strategic consolidation. We saw Shell announce a massive $16.4 billion agreement to acquire Canadian energy firm ARC Resources.
That seems like a direct geographic hedge against the Middle East chaos.
It is. Buying Canadian assets secures physical production in a stable North American jurisdiction far away from the Strait of Hormuz.
It is a textbook pivot to secure supply chain resilience. We also saw BioMarin Pharmaceutical finalize a $4.8 billion acquisition. But perhaps the most strategically revealing corporate move happened in Cupertino.
Apple.
Yes, Apple. The sources confirm that following the news that Tim Cook will officially step down in September 2026, Apple has selected John Ternus to take over as CEO.
Which is huge.
Ternus is their longtime hardware engineering chief. In a tech landscape that is currently obsessed with cloud infrastructure, massive language models, and software-centric AI, Apple choosing a pure hardware executive to lead the company feels like a massive strategic statement.
It is a profound declaration of their structural philosophy. While companies like Microsoft and Alphabet are battling over the software layers of AI, Apple is doubling down on the physical interface.
Right.
Ternus's appointment signals that Apple believes the ultimate value in the AI revolution won't just be the intelligence in the cloud, but the physical devices.
The silicon, the sensors, the thermal management of the iPhones and wearables that actually deliver that intelligence to the human user.
They are betting that owning the physical hardware bottleneck is the ultimate moat.
It all circles back to the tension between the physical and the digital.
Okay, we have covered an immense landscape today, from the Strait of Hormuz to the semiconductor fabs, from the Federal Reserve to the local dominoes. Let's try and synthesize the reality of April 27, 2026.
It's a lot to take in. We are observing a global economy suspended on a razor's edge. The stock market is pricing in a multi-trillion-dollar technological utopia powered by AI inference and unprecedented semiconductor efficiency.
But beneath that digital euphoria, the physical world is fracturing.
A war in the Middle East has weaponized global supply chains, choking off energy, spiking food prices, and pushing the everyday consumer into a stagflationary corner where they are terrified by the cost of simply living.
And attempting to manage this impossible contradiction is a paralyzed Federal Reserve.
Engulfed in political scandal, betting on a theoretical economic model that AI productivity will miraculously cure the inflation caused by a physical war.
It is a high-wire act with virtually no margin for error. The equity markets, sitting at these record valuations, have priced in absolute perfection.
Which rarely happens in reality.
No, it doesn't. They require the AI revolution to be deployed seamlessly, and they require it to generate massive deflationary productivity before the consumer breaks under the weight of 108 oil.
So, as we wrap up this deep dive, what is the underlying thread you should be pulling on as you navigate the weeks ahead? What is the unseen risk in this entire framework?
Well, the core assumption driving everything right now is Kevin Warsh's thesis that AI will generate enough productivity to offset the geopolitical inflation. But the market is treating that assumption as an absolute certainty rather than a probabilistic outcome.
Right.
So I challenge you to consider the alternative scenario. What if the global supply chain has fundamentally deglobalized?
What if the maritime blockades and the Houthification of regional conflicts are not a temporary disruption, but a permanent feature of a multipolar world?
Exactly. If the geopolitical friction makes $100 plus oil the permanent baseline for the global economy, the math changes entirely.
Because if the physical pain of inflation is permanent and the AI productivity miracle turns out to be structurally delayed or, less deflationary than anticipated, the Federal Reserve will have absolutely nowhere to hide.
The market is pricing in a rapid digital salvation. But history suggests that escaping the gravitational pull of physical commodity shortages is never that simple or that fast.
The digital rocket is fighting against the physical gravity, and the fuel gauges are flashing. We are going to keep watching the dashboards, the data, and the discrepancies. Thank you so much for joining us on this deep dive. Keep questioning the consensus, stay curious about the mechanisms underneath the headlines, and we will see you next time.